There is a number in your bank account right now. You check it on your phone, you see the digits. You assume that number represents safety. You assume it is a shield against the uncertain future. But look closer. That number is not a shield. It is a melting block of ice, and you are holding it in your bare hands. Every day, silently, without a single notification on your phone, a fraction of that number's power is siphoned away. You haven't spent a dime. You haven't made a single bad purchase. You followed all the rules. You worked hard, you lived below your means, and you saved. And yet, you are slowly, mathematically becoming poorer. Welcome to the greatest optical illusion in modern finance, the illusion that saving your money is the safe thing to do. For 50 years, the middle-class dream was built on a very simple, very comforting equation. Go to work, earn a wage, spend less than you earn, put the remainder in a savings account, eventually retire. It was a good equation. It was safe. It was respectable. There is only one problem. The equation is completely broken. To understand why saving your money is no longer enough, you have to understand a fundamental shift in how the global economy operates. We need to talk about what money actually is today. Most people still think of money as a static measure of value, a financial yardstick. If you put $1 in a jar, you expect it to be worth $1 in 10 years. But money is no longer a yardstick. It is a stretching rubber band. When global central banks need to stimulate economies, fund deficits, or manage crises, they create more currency. It's a complex mechanism involving bond yields and overnight repo markets, but the result is brutally simple. The supply of money expands. And when the supply of anything expands, its individual value drops. We call this inflation, but the word inflation is too clinical. It makes it sound like prices are magically floating upward. Prices are not going up. The value of your currency is going down. Let's look at the uncomfortable math. If official inflation is sitting at, say, 3% and your high-yield savings account is paying you 2%, you are not making money. You are paying the banking system 1% a year for the privilege of watching your purchasing power evaporate. Over a year or two, you barely notice it. It's a slightly more expensive carton of eggs, a higher rent increase. But stretch that timeline. There is a concept in finance called the rule of 72. You divide 72 by the rate of inflation to see how long it takes for your money to lose exactly half its buying power. At 4% real inflation rate, the money you sweated to save today will buy exactly half as much in 18 years. 18 years, that is the time it takes a newborn to graduate high school. In that time, half of your life's stored energy, gone, vanished into the economic ether. Now, we need to talk about what actually happens when you deposit your paycheck. You probably imagine a vault, a digital lockbox holding your specific dollars, waiting patiently for you to withdraw them. But banks are not vaults. They are financial engines. When you hand them your savings, they do not hold it. They immediately turn around and put it to work. They lend it out for mortgages at 7%. They fund corporate debt at 8%. They buy government treasuries. They invest your money. Think about the profound absurdity of this arrangement. You are too nervous to invest your money, so you give it to a bank, ostensibly for safekeeping. The bank takes your money, immediately invests it in the exact same economic system you were afraid of, absorbs all the profit, and pays you pennies on the dollar for providing them the capital. You are already an investor. You just have the worst portfolio manager in the world. So what is the alternative? How do you cut out the middleman? You have to transition from a saver to an investor. You have to move your wealth from cash, which is designed to depreciate, into assets, which are designed to appreciate. But the moment you decide to do this, you step into a minefield. If you type the word investing into a search bar today, you are immediately assaulted by noise. Teenagers in rented sports cars selling algorithmic trading courses, cryptocurrencies named after dog breeds, high-leverage options trading on meme stocks. This is not investing. This is the financial equivalent of a Las Vegas casino painted with a fresh coat of Silicon Valley marketing.
The financial entertainment industry wants you to believe that investing is about outsmarting the market. They want you trading daily, checking charts hourly, and paying transaction fees constantly. Real investing is remarkably boring. It does not require multiple monitors. It does not require insider knowledge. Real investing is simply the act of buying a tiny fractional slice of human productivity and going to sleep. When you buy a broad market indexed fund, for example, you are not betting on a single CEO. You are not guessing which phone manufacturer will have a better quarter. You are buying a microscopic piece of the hundreds of most profitable, ruthless, efficient companies on Earth. When you hold cash, you are betting on the restraint of politicians and central bankers. When you hold productive assets, you are betting on the collective desire of humanity to wake up tomorrow, build things, sell things, and make a profit. Historically, only one of those bets has ever paid off. But here's where the mental block happens. Here is why people freeze and keep their money in the melting block of ice. Volatility. People confuse volatility with risk. They are not the same. Volatility is the price fluctuating day to day. A stock market dropping 10% in a month is volatile. It feels dangerous. It triggers the primal fight-or-flight response in our brains. But risk? Real risk is the permanent loss of purchasing power. Cash in a bank vault has zero volatility. The number never goes down. It feels incredibly safe, but it has a 100% risk of losing its purchasing power over a 20-year timeline. A broad portfolio of assets has high volatility. The numbers will bounce around wildly, but historically, over a 20-year timeline, it has a near zero risk of losing its purchasing power. You have to choose your hard. You can accept the short-term emotional discomfort of seeing your portfolio turn red on a Tuesday, or you can accept the long-term mathematical certainty of being unable to afford your retirement. Let's zoom out, because this isn't just about personal finance anymore. This is about the fundamental structure of society. We have entered an era where the global economy is splitting entirely into two distinct groups. It is no longer just the working class and the wealthy. It is those who work for their money and those whose money works for them. The great divide of the 21st century is asset ownership. When central banks print money, that money does not flow evenly into the pockets of the working class. It flows into the financial system. It flows into assets. This is why, during periods of economic crisis, you see the stock market hitting all-time highs while the lines at the food bank get longer. If your wealth is measured purely by the hours of labor you can provide, you are playing a game you cannot mathematically win. Your physical energy is finite. Your time is finite. You cannot work hard enough to outpace a money printer. The prices of homes, energy, and food will continue to escalate at the rate of monetary expansion. Your wages will escalate at the rate of your employer's generosity. Those two lines do not intersect in your favor. The only way to bridge that gap is to own the things the printed money is chasing: real estate, equities, hard assets. You must own the underlying infrastructure of the economy, or you will eventually be priced out of it. Turning saving into investing is not a get-rich-quick scheme. It is a slow, methodical process of transferring your energy from a depreciating vessel into an appreciating one. It starts with an emergency fund. Yes, keep 3 to 6 months of cash in the bank. You need a buffer for life's actual emergencies: a broken transmission, a sudden medical bill. That cash is not an investment. It is insurance, and insurance costs money. You accept the inflation loss on that small pile of cash because it protects the rest of your life. But every dollar beyond that, every dollar sitting idle, waiting for a safe moment that will never arrive, that is capital that needs to be deployed. Set up the automated transfer. Direct a portion of your income into broad market funds. Do it before you have the chance to spend it. Do it before you have the chance to rationalize why you can't afford to invest this month. Buy the market. Ignore the financial news. Ignore the talking heads screaming about the next impending crash. They have predicted 50 of the last 2 recessions. Understand that there will be years where your portfolio drops 20%. There will be economic winters, but the overarching trajectory of human progress, the relentless drive towards efficiency, innovation, and profit, has always trended upward. The old rules are dead. The financial safety net your parents believed in has been dismantled and sold for parts. You can hold on to your cash. You can stare at the digits on your screen, hoping the math changes, hoping the system magically reverts to a 1950s ideal that hasn't existed for decades. Or you can look at the board, recognize the rules of the game that is actually being played, and move your pieces accordingly. The melting block of ice is in your hands. The only question is, how long are you going to hold it?